Welcome to the Alpha Beta Research Weekly Strategy Briefing. We are currently tracking a severe divergence in global markets that challenges the traditional relationship between macro data and equity valuations. On one side, we see stagflationary signals. Energy-driven cost-push inflation is accelerating, while the labor market is beginning to show a measurable deceleration. This dashboard illustrates the tension. Despite macro headwinds, S&P 500 earnings projections are climbing toward $340. High AI capital expenditure generates enough nominal profit growth to offset negative data, lowering the equity risk premium and maintaining high PE ratios despite elevated capital costs. This market resilience depends almost entirely on tech hyperscalers maintaining their current spending trajectory. It is a narrow foundation that leaves little room for error. While the surface-level indices remain calm, institutional indicators suggest a growing caution among large-scale investors. This chart shows the divergence between the VIX, which is hovering at low levels, and the SKEW index, which has spiked to 149.60. This tells us that behind the scenes, institutions are aggressively building protection against tail risk events. The fragility of the current digital AI trade became evident through what we've termed the Fujikura anomaly. Fujikura, a critical provider for fiber optic networks, recently reported record profits. However, the stock dropped 19% the following day. This sell-off was triggered when the company issued a conservative outlook for the next quarter, citing potential supply chain disruptions. When the core supply chain is priced for absolute perfection, even minor guidance adjustments can trigger significant pullbacks. This creates a scenario where capital begins shifting toward unpriced peripheral sectors that haven't yet reached these valuation extremes. We use historical analog modeling to project where this rotating capital is most likely to flow as the cycle matures. Our model identifies the 1998 to 2000 IT infrastructure boom as an 85% match for the current cycle. The main difference today is the strength of corporate balance sheets. Current hyperscalers are investing from massive cash reserves rather than through the high-interest debt seen in the late 90s. In that era, capital moved in a specific sequence, first to software and core tech, then to network routers and fiber, and finally into the physical server rooms and power infrastructure. We believe the market is now entering the final stage of this sequence. With semiconductors and fiber optics already highly valued, the focus is shifting toward the physical foundations, the cooling, the power, and the space required to house these assets. To find the next source of alpha, the strategy must move past the technology itself and toward the infrastructure that makes that technology operable. This structural shift is being dramatically accelerated by a specific engineering challenge, the extreme thermal output of next-generation GPUs. Traditional air-cooled server rooms were not designed for this level of heat density. Mathematically, air cooling is reaching its physical limit for the power loads required by modern AI clusters. The industry is moving toward containerized data centers, modular, high-density units that can be deployed rapidly and managed with far more precision. Inside these units, the primary bottlenecks are liquid cooling systems and specialized uninterrupted power supplies. These components are now the essential gear for the next phase of the build-out. As data centers reach these physical limits, managing heat becomes a primary factor in determining who captures the next phase of capital expenditure. This shifts pricing power toward the HVAC, mechanical, and power grid sectors. Complicating this tech cycle is a secondary historical analog, the supply-side energy inflation of the 1970s. Tensions in the Strait of Hormuz are recreating this cost-push dynamic, where energy transit disruptions risk driving inflation higher regardless of consumer demand. We are in a market where massive tech investment is clashing with these geopolitical bottlenecks. It creates a volatile environment where productivity gains are fighting against rising input costs. Because of this, a technology-only portfolio is vulnerable to external shocks. A geopolitical energy hedge is now a necessary component for risk management. Our specific allocation strategy begins with a major systemic shift in the Japanese market. The Bank of Japan has officially raised its policy rate to 1.0%, a clear departure from the era of zero interest rates and deflation. At the same time, the Ministry of Finance is encouraging domestic pension funds to repatriate capital. We view Mitsubishi UFJ as the primary vehicle to capture the resulting margin expansion within the Japanese banking sector. For the physical AI rotation, TakasagoThermal and SanyoDenki are top picks. Takasago's order backlog surged 51.2%, without the typical valuation re-rating. These backlogs are driven by containerized data centers, a trend the market is just beginning to recognize. The most significant upside in Japan currently lies with these infrastructure companies. They are showing record-high fundamentals, but still trade at traditional industrial valuations. In the U.S. market, the focus is on balancing physical infrastructure with defensive inflation hedges. We recommend overweighting the utilities and capital goods sectors, specifically ConstellationEnergy for its nuclear power capacity and Vertiv for its thermal management systems. These companies provide the 24/7 power and cooling required by hyperscale facilities. To protect against geopolitical energy risks, we include the XLE EnergyETF. This serves as a vital hedge against the supply chain disruptions we discussed earlier. There is a critical invalidation trigger for this thesis. Any reduction in AI-related capital expenditure guidance from major hyperscalers during the upcoming earnings season would void the current momentum. We suggest avoiding legacy SaaS and REIT-sensitive consumer sectors. As corporate budgets shift toward AI hardware and physical infrastructure, legacy software spending is likely to be deprioritized. To access our full historical matrices and risk parameters, join the Alpha Beta Research platform at alphabeta-research.ai.